So can we start with it?
Yeah, sure.
So just a quick check on can everyone hear the audio and see the screen? Awesome. So hi, my name is Josefa and I'm from the support team of Tradetron.tech. Today we are having a session on option Greeks with someone who needs no introduction, Mr. Vivek Gadodia. He is the co-founder of Dravyanati Consulting, and he runs this strategy which is also on Patreon called Kinetic, and an awesome performing strategy. He has been in the market since the last 8 to 10 years, so definitely a market veteran, and he will be taking up this session on option Greeks. So uh, all power to you.
Thanks, Josefa. Hey, everyone. So what we're going to just do is look at a couple of the Greeks today, and we'll see how we can apply them in the trading. So I hope you can see my screen here, the presentation. Okay. We are going to basically look at Delta and Vega. These are two of the Greeks which are we'll be talking about today. So to simplify it, you can always remember easily Delta starts with D, right? So D, it deals with direction. It is connected to direction. Okay. And Vega, which starts with V, is connected with volatility. So let's look at Delta. So what is it meaning? In simple words, it is how much does the option price change with respect to change in the underlying. Right? So let's look at something like a at the money Nifty options. So we'll just basically look at the option chain for the current option chain for better understanding. So Nifty right now is around 17,500. So this is the at the money. And we can see that so this left side is all the call options and the right side is all the put options. Right? So everything in basically below 17,500 strike, these are all in the money and all the above are the out of the money. So that's shaded like this as well. So the at the money is basically 136 rupees, the 7,500. And usually the at the money options delta is 0.5 or half. So what it means is that if tomorrow Nifty goes up by say 100 points, this call option will go up by approximately 50 points. And so basically if Nifty goes to 17,650 or something from say currently 550 or something where it is, this option will rise approximately 50 rupees. So 136 will become about 186 rupees. Okay. And call options will always have positive delta because as the market will go up, the call options are expected to go up. Now, put options on the other hand will have delta of the ATM put will have approx negative 0.5 delta. So basically the 17,500 put is around 146 right now. If tomorrow Nifty goes up 100 point, this option we can expect it will fall by about 50 points. So it will become probably 96. So call options will always have positive delta and put options will always have a negative delta. Okay. So now if the put option goes down by 100 points, obviously, then the Nifty goes down by 100 points, the put option will go up by 50 points. Actually, that's why it has got an inverse correlation with the underlying. Now, things to know, this is somewhat, some of you will know this, but these rules apply mostly when the option is not very close to expiry. It will apply in most of the other times. If it is very close to expiry, then some other forces will also play in and the other Greeks will also play in. And these behaviors will not be exactly similar. So let's see now, how do we use this practically in our trading systems? Because end of the day, this theory is of no use till we can apply it and how to apply it, right? So how I use it is that if when I'm buying options, I'm always looking to buy something like half delta or more than that. So basically it has to be either at the money or it may be in the money. So for example, right now, if there is a 17,500 call, I may or either buy that or I may buy a 17,300 call, right? So this is not 700, this would be 300, right? So 17,300 or 7,200 may have delta of about 0.7, 0.65, 0.7 something. So if Nifty goes up 100 points, that option is expected to go up around 60, 70 points. Now, why would basically I look to buy only at the money or in the money? The reason is because if you think of delta, also you can think of it as the probability of you making money on that option and its expiry. So if a delta is 50%, the chance of that expiring in the money or you making money is 50%. If the delta is say of an out of the money option is say a 17,800 or something, if we see, let's just go back quickly to that option chain. So say something like a 17,800 here, which is 38 rupees. Well, this appears cheap, right? And most of us make that mistake in the beginning where we think the cheaper options are the one which we can buy and where, this 38 we expect will become 300 and 400 and, I'll multiply my money by 8 or 10x. Well, I mean, most of us make that mistake initially, but believe me, whenever, if that happens, the chance of that happening is very less. Like it's maybe a 20% chance. And when you're really lucky and like, if you get a big move in that direction and and you're really lucky, it can tend to make money. Otherwise, most of the options are going to lose money. So you will be hearing why they say most of the time the option writers are making money and buyers, 90% of them are losing money. Who are those? They are basically, if we are kind of in this camp of trying to buy the deep out of the money of our OTMs, which look very cheap and whose deltas will be 10, 20 or something. The chance of that making money is 10% or 20%. Right? So till I did not know about the Greeks in detail, I think I was kind of trying to just fight a battle which is losing battle eventually. Right? So when you buy a 50% delta or a 60, 70% delta, even if the move is not as much in your favor, at least that option will have some money. It will have some value left. So you will not lose your entire premium and you can basically still salvage that trade much and move on to the next trade, right? So I always look to buy either half delta or more than that, right? And avoid these out of the money options. So in option buying, then what is important is that along with what strike you're buying, it also depends on how certain or how probable is that move likely to happen. Because if you're just buying options all the time without a higher chance of the underlying moving, it's again a big force against you, which is always the time value decay, right? Which we are not talking about in this, but some of you will know, like it's the theta or the time value decay, which just to know as a buyer, that is basically your enemy. So till you don't expect a bigger move in your direction, it's like buying options can be very tricky. So when to buy, what to buy, and when to get out is very important. And we'll then look at, right? So the next Greek, which is a little more complex than delta. Right? Delta that way is quite simple. So we are going to talk about Vega. So what is basically the expectation of changes in volatility in the market? How does that affect option prices that is covered by Vega. So volatility that is there in the market is an estimate. It is the only, you can say, unknown variable in the price of the option, where it's a Black-Scholes formula we use, where you have the strike, the underlying interest rate, and time to expiry, and volatility. So volatility is that factor which is an estimate. It's basically derived by the traders, and it depends on how much we expect as a move that is going to happen in the market. So, for example, today, if all of us are expecting that market is going to move by a certain percentage on average expectation of all of us, that is basically reflecting in the volatility or the IV value. So you sometimes see that this volatility is quoted like in number, like say 20, 25, 30. For example, let's just look at the current IV of the same option. The 17,500, this is for the weekly expiry of the coming Thursday. So that is 21st of April. This option is basically showing IV as 12.49. So basically the expectation of the traders is that the Nifty is likely to move by about 12.5% in 1 year. This volatility is like an annualized number. Now, how do we use it actually for our trading? So this 1 year is basically a direction of 12.5% can be either up or down, right? Like whether the traders are expecting market to go up or down is not determined by volatility. So volatility does not have any directional aspect to it. So if we say from a calculated perspective, let's just say quickly 17,500. Can you see my Excel screen?
Yeah, we can.
So you have 17,500, and let us say we calculate say 12.5% of this. So it's 2187. So what the traders are expecting sort of is that the Nifty range for 1 year, you can say upper range is 17,500 plus 2187, and the lower range is say 15,300 on the lower side. Now this is basically a estimate of 1 year, right? But it's too long. Like how are we going to use this? Just before coming to that, I'll just talk a couple of things about volatility. Is that it's always eventually going to mean revert. So like we'll see price of a stock, it is maybe it's a good company, it's eventually going up. Right? The price is going up, like even if there are crashes, corrections. Nifty eventually is expected over the years that it's going to go up. So it's an aggregate of say the top 30 stocks, the country. But volatility is going to mostly remain range bound. So in general, let us say Nifty's volatility may remain around 17 or 18. Right? If sometimes when the COVID crash had happened, the spike volatility went up to 100 or something, right? Where the estimate was 100% movement in the market. But eventually it came down, and right now it's at 12. So it will always eventually be in a range, but sometimes it can extend a lot before it comes back to revert. So just because volatility has risen, if we short it expecting it will come down without having risk management or any rules to control that, is a short recipe to disaster. At some point it can just blow up. So the volatility can go a lot more up before it comes down or cools off. So while selling option, this is something that we want to really take care of. Okay, so now let's see how to use this. So if I will just use this 25% IV example. So if IV is 25, when it's 25%, expected 1 day move in market is nothing but 25 divided by the square root of 250, because there are around 250 trading days in 1 year. So that basically square root of 250 comes to around 15.8 something. So when you do 25 divide by 15.8 around, we'll get value of around 1.58%. So basically what the traders, if the vol is 25, the traders are expecting that a 1-day range of market can be 1.58% up or down. So the 12.5% currently that we are seeing is suggesting around 0.79% movement in a day. Let's quickly look at the bank nifty also. So if we just see bank nifty. Okay, so we go to the option chain and we will take, say, the 21st, and we will take, okay, we just scroll down to the, so 37,500 is at the money right now. And you can see the IV is 16.81. I don't know if it's, is it too small or is it reasonably visible?
It's reasonably visible.
Yeah, I'll just try to zoom it up a bit more. Probably better. Yeah, so 37,500, it is showing IV as 16.81. So 16.81 for bank nifty is a little more than, not little more, quite more than nifty actually. Nifty is around 12 and this is around 17. The difference between that is like, if you actually take 16 minus 12, we get around 4.8, and 4.8 divided by 12 actually is like around 40%. So the volatility of bank nifty as such is around 40% higher than nifty, and traders will know that by nature bank nifty generally tends to move more. So if we want to get the 1-day expected range of bank nifty, we will get this divided by square root of 250, which is basically around 1.06% is the expected range which traders are thinking of that can happen in the current bank nifty. So now that we have a little bit more idea about the volatility, it still is tough to use it because as long as it's in percentages like this, it's tough. So we'll look at how to use that using IVP in the next slide. But before that, looking at Vega, which you see in options, it is, if the Vega value is 10, it means that a 1% rise in volatility is going to increase the option price by 10 points. So if the volatility is say 16, and 1% of that is basically nothing but 0.16. So this plus, if the vol goes to 16.16, that's a 1% move, and that will increase the option price by 10 points. So, and other thing is this Vega is always positive for both call and put, because whether it's a call or a put, once the option price, once the volatility rises, the option price will rise. Other things being equal, volatility effect is always going to lead to increase in vol, will raise the prices of options because traders are expecting more movement, and maybe the people who are buying put options to hedge their portfolios and all, they are ready to pay a higher price for the insurance of their portfolio. So basically the option trading starts from put buyers who are buying those puts to protect against any down movement of their portfolios, and that's where when fear rises they will pay more premium, and when the put values rise then the call values also rise commensurately to match up like with the because of the put call parity. Now interestingly, on 24th August 15, just to give you an example of this point to highlight, Nifty had unexpectedly crashed about 5% overnight. It was Monday, I think. And on that day, both the call options and the put option prices went up. Now, imagine the market falling 5% and still the call options, which are supposed to go down a lot, going up. Why did that happen? because the increase of the option price as a result of the change in volatility was so drastic that whatever loss was happening due to the delta movement, which is the underlying movement, was more than offset by the gain in the price because of the total sharp rise in volatility. Like VIX rose some 64% on that one day. The volatility just shot up by about 65% in a single day. And thing to remember then in this is that these will generally behave and apply like this when there are more days left to expiry, but as and when we start coming near expiry, the things may start changing. So how do I use the Vega now for trading rule? Like how in Delta we saw that for buying options, I would basically tend to use a half delta or more than half delta. I would avoid buying anything like 0.2, 0.3, those kind of delta. Similar to that, for the volatility, how do we use that now as a rule? So before doing that application, there's one more step we have to do is change the IV values, which can range from 5, 10, 20, 100, 200, like that GameStop example. If you remember last year, GME short squeeze that happened, the volatility had actually gone to 1000. So the volatility of GME had gone to 1000%. So how do we use that? So whether that 1000 is more or less, because for different instruments, what is different, like Nifty is different, Adani Ent will be different, JSW Steel will be different, Marico will be different, like that. So we have to find out the volatility of an instrument with respect to itself. So do that, we just take the past 250 days volatility values, the IVs, and we want to find that the current IV, where is it with respect to the last 250 days. So you can do that very simply. We can do it using a function called percentile in Excel. So let's say an IVP of 25. Suppose we get an IVP and not IV now, it's just IVP, the percentile of 25. Say this is the IV range of the last 250 days. If IVP is 25, which is here, it means 75% of the time in the last 250 days, the IV was higher than where it is today. Right? So it means that IV is in the lower part of its range. Right? IVP of 25 sort of. Zero IVP means it's least in the last 250 days. Matlab, isse niche tha hi nahi. This is the least IV that we have seen in the last 250 days, right? So for it, can it go lower? Yes, it can remain low and it can remain at zero for a while. But at some point it will revert. Okay, it will not stay there forever. Same way, a IVP of 100 means the IV is highest in the past 250 days. So like when the COVID crash happened in February, March 2020, the IVPs had, say, IVs had gone to 100, 200. For Bank Nifty, the IV went to around 200 also. Right? So the IVP had gone to 100, means it was highest in not in 250. It must have been over the last many years, it must have been the highest IV. But eventually it came down. And in last August, September or something, the IVP was around zero. And it remained there near 0, 10 or something for 2-3 months. So you can just see how extreme the sentiment is. And it's captured best in the option prices. And using IVP, we can then now basically use some rules or framework on how to trade using the IVP. So if you have any questions on this later, we'll have some time probably for Q&A. Okay, so now how do I use this as for trading? I look at if the IVP is less than 25, like we said, means IV is in the lower range, say, of itself in the past of day, I would be looking more aggressively for option buying strategies, because it means that now volatility is low, so options may be cheaper. So see, a volatility of 15 or 20 does not mean that it will move by 15 or like that 1.5% only, right? Tomorrow Nifty can fall probably with the news, the way the Infi ADR is and tanking, and we might see a 200 point, 250 point gap down, possible. Or if the news changes and something else can turn. But if no, then probably it can open down 1.5%. So in that case, what will happen is, if it does, probably the IV can shoot, probably. And so, and the option values can go up much more, because the volatility increase will increase the price of the option. So if somebody, when you want to know if options are cheap or expensive, you can always look at, if the IVP is in the lower range, it means option is cheaper. It doesn't mean like a 200 rupee option is cheap or expensive. We cannot say. We have to look at the IVP to find out whether an option is cheap or expensive. So between 30 to 75, let us say when IVP is in a medium kind of range, we can look to do option selling strategies, because if the market kind of mostly behaves around what it expected or even little more deviates, the option prices are reasonable enough priced. So when we are selling those options, we will get reasonable premium and we will not get hit a lot. So let's say, in other words, we are not selling cheap options. We are selling an option when they are reasonably priced or maybe a little overpriced. And if the actual movement happens to be much lower than we can tend expected, then we'll tend to, even if it goes around expected, we may earn money, because the actual volatility may be lower than what was the volatility realized. So that's a little advanced kind of thing I'm not covering in this, but when we look at the strategies and course in the course and all, we can basically talk about that. So between 30 to 75, we can look at selling strategies. And finally, if it is above 75, like if it's extreme, right, I would probably avoid both writing and buying. Now, some people will say buying, yes, it's understandable, it looks very expensive. So it means even if the move comes, the option is so expensive that it can tend to lose money. So if you've heard at time price will go up, but the call will fall, that is generally when the market is already expecting that. So, then the price of the option will fall in spite of the underlying going in your direction. And why would I avoid selling is because the extremely big moves are also likely to happen in very high IVP. So if the market is sensing something may be wrong, some of the times it may not happen, right? It may be favorable, but sometimes something extreme can happen. So I would rather tend to avoid, or if we do sell options at that point, I would say we should always, I think, hedge it. So we can always buy options for protection along with the short option, so that if something extreme happens, then you always are covered. Even otherwise, in the selling, we suggest that you always have to have your stop loss on the option short. And if you're a more conservative kind of trader, along with shorting, you can also buy options as a hedge. So if you're selling a straddle, let us say, you can buy a strangle for a hedge, right? So that covers the presentation. Joseph, I want to just talk a little bit about the details of the course and then go in for Q&A.
Yeah, so hi. We are launching a course which is called Trading Strategies with Vivek Gadodia. In this course, we will be covering content like you just saw. So this was somewhat like a trailer, but we will be going very much in depth on option Greeks. We will be going into strategies, so live actionable strategies that you can use, and all of this with the help of Tradetron. So we will be using Tradetron as our algo engine, and we will be building these strategies that will be discussed in detail by Vivek, of course. And using these strategies, we will learn how to gauge the market, how to make bets in our direction, how to make non-directional bets. There will be option buying strategies as well as selling strategies, and of course, along with that, you also get to learn a lot about the markets in general. So this course will be a 2-month long course, and it will be having 32 hours of content, and all of this content will be live content. So that will be covered on live sessions like the one out here. We will be doing this on Zoom, and the course is very reasonably charged at 7,000 rupees. It will be covered on Saturdays and Sundays. The timings of the course would be 1:30 to 3:30 on Saturdays and Sundays, and we would be happy to welcome you to the same and to walk you through any questions if you have in the same.
Yeah, thanks. Just to add, basically, to talk a little more about the momentum option buying strategy, like to give one example, it will be like a complete rule-based system on when to buy options for Nifty and Bank Nifty. So it's a directional strategy, which is both long and short, with a pretty reasonable return and a low drawdown. The complete rules of the strategy will be shared with back-tested results, and you can deploy that on TradeTron. And in the non-directional selling strategies, we'll be covering a complete rule-based system on how to write options for Nifty and Bank Nifty with reasonable return expectations, but always having a defined risk. So how do we do a position sizing, even things like when volatility changes, how do we adjust the size of the positions? And then we can talk about like combining a few strategies of these together. So it will include a complete framework, how you can trade a directional index as well as non-directional index and build a bouquet of strategies for yourself. And the last 2 weeks, we'll also be covering about back testing, and you can always use these strategies not only to maybe apply only this. You can always take these as an example of a framework and maybe build your own around it, or tweak this to make it your own. Or if you have your own thought process which you want to test on TradeTron, maybe take it live. These kind of strategies may also help you to formulate your own plans. So many times we say that we don't want to give like one ready-made template and you just follow it as is. You could use it, you could change it, or you could use it to build your own thought process on how to build a complete trading system from start to end. So this is where I think you can, if you would like to enroll, you can go ahead and click on the enroll button, and these are timings, like as I said, 1:30 to 3:30 on Saturdays.
I've also sent the link of the same website on the chat. So in case you are interested, you can just click on the link and you'll be redirected to the same web page. So let's take up some questions now, Vivek.
Yeah, sure.
One interesting question is by Mr. Mayank. He's asking if recordings will be provided. So yeah, recordings will be provided. We will give you access to all the recordings of all the sessions, and you will be able to get access to those recordings for 1 month after all the sessions end. So in essence, you would be getting recordings for like a 3 to 4 month period from the start date of the course. One other question that someone is asking on Vega is, what's the difference between VIX and IV?
Yeah, great. So VIX is basically a volatility index, which is derived from taking the IV values of, I think, the next 30-day option prices or something. So it takes monthly and weekly. If you want the detail, I think there's a white paper. It's a little complex calculation, but it's on the NSE website. If you just Google VIX white paper, you will land up on it. So it's basically using a chain of the options, and it estimates the volatility based on that. Whereas when we talk of the IV of a particular option, it is the IV of that strike. Now, as for your trading purpose, we have seen that most of the time using the IV, like we just discussed, that we have found is more practical and more useful from a trading standpoint. It's more dynamic, whereas the VIX, because after the weeklies have come in, I think the IV that we see of the weekly option ATM is the more relevant IV and volatility that most of the participants in the market are expecting. But if you're doing more longer time frame strategies or something on daily data and all, possibly maybe then even the VIX data can help you.
All right. Another question is, can I build and backtest advanced strategies after completion of this course? So yeah, you will be able to build strategies, and of course, backtest is always a feature within TradeTron's engine itself. So yeah, you will be able to do that. Another question here is, will we be selecting weekly or monthly options? So what will be our selected strikes and the expiries?
So we will be dealing with the weekly options because these strategies are, the very short term moment. The buying is typically 1 day average holding. So we find it works best on weeklies. But if you find something more comfortable or better in the monthly, you can test and obviously try. And like Josefa said to the previous question, if can you do advanced strategies, it's always the intention of these course is to make the building blocks for you solid, and then you can always keep adding to that and move to little more complicated strategies also as you find it comforting. So our idea is to give you the building blocks of how to build, how we think we should build systems. And a lot of practical things also in that, because there is a lot of psychological element also that comes into while trading. So we'll try to touch upon little bit of that within our practical learnings in one or two of the sessions.
Okay. One question asked by Mr. Narinder is, what all Greeks can practically help in trading that we should know, covered in the course?
So we'll be covering, along with this, we'll be talking of theta. So these are the three we think which covers is enough to do most of the kind of trading reasonably well. We use that, and we don't feel that there is any need to go to much more advanced Greeks beyond this at this point. So if we get this, master this well, practice it, learn it, and implement it, that's reasonably good to survive and make money in market.
Another question, can we build strategies on TradeTron with combined option Greeks and indicators? So yeah, Mr. Vinod, this is possible. You can combine option Greeks as well as technical indicators for your strategies on TradeTron. Does anyone have any more questions? If not, we can wrap up this session. So I guess that's it. Thank you very much, Vivek. That was a great learning session. A small teaser for the overall course. Thank you very much for it. Let's meet up soon or next week when the course begins.
Absolutely. Thanks a lot, Josefa. Thanks a lot.